Hello, everyone. Welcome to part two of our discussion of retirement plans. We finished up employer-sponsored retirement plans, and we're on to individually sponsored retirement plans. Now, I want you to remember that at least both of these, okay, that we talked about in an employer, there's an IRA account set up for each employee, even though it's the employer who does it um, and makes the contributions and so forth. It really feels an awful lot like an IRA that we're talking about here. The difference here is this is set up and administered entirely by the individual, and they then have the agreement with the account holder, the trustee we talked about earlier. So you go into your bank or your other financial institution and you sign a individual retirement account agreement that basically sets up the restrictions on the account and sets up that bank as the trustee for your IRA. So notice that the limits for 2019, $6,000, can't be more than your actual compensation. You cannot, except in the situation of married filing jointly, where one spouse doesn't have income. As long as the other spouse has enough to cover, they can make a contribution for both spouses. So as long as their contribution is, their income is at least $12,000. We refer to it as a spousal IRA. It was basically set up for the stay-at-home spouse who doesn't have income and wants to make a contribution towards retirement with the idea that savings possibility. So you set up an IRA and you can make that contribution. Otherwise, absent that exception, you can only contribute to an IRA your compensation. Okay, so if you only make $3,000 for the year, then you cannot make the full $6,000 contribution to the IRA. And then you notice it's a little higher for if you're 50 and older, that catch-up that we talked about earlier. Now, where this has an issue is the amount that you can contribute and deduct for a regular IRA is limited if you have you are in a plan at work. So if you participate in a retirement plan at work, then you could have the amount that you put in, at least the amount that's deductible, be less than the $6,000, $7,000 we talked about. Okay, so when you reach 103 if you're married, or 64 for everybody else, and it phases out. Notice the phase out range is 20,000 and 10,000 respectively. Okay, married filing separately, another penalty for those folks. Phase out starts at 0. Right. So as long as your income is below 103 as married, if you're married filing jointly, even though you participate at work, you can still make the fully deductible contribution to IRA. But as soon as it reaches 103, and this would be your total AGI for the couple, then it could be reduced. And if your income is over 123 total, and you have an employer plan at work, then you can't make you cannot deduct any of your IRA contribution. It's fully phased out. Now, what if you got two married taxpayers? There's two people. So how does that work? If both are employed and neither of them are, participate at work, then you're good to go on the limits. Okay, it doesn't matter what your income is. If you don't participate at work, you're fine. You can make the full contribution to your IRA and deduct the full amount. All right. We already talked about spousal IRA. If one spouse is covered under an employer plan, the other is not. So one has a plan at work and one doesn't. All right. The one that is covered at work, we already talked about. That limit was on the slide before. But what about the other spouse that doesn't contribute to work, has income, but doesn't have, a possibility of making a contribution at work? They can, as long as make a full contribution, as long as the AGI is below 193. But it does phase out after 193. Okay, so it's as your income gets to 213, a $20,000 phase out range, then even the person who didn't participate at work, as long as, because the other spouse participates at work, cannot make a fully deductible, you can't make a deductible IRA contribution. Now, if you don't qualify to make, can't deduct it, you can still make a contribution as a non-deductible IRA, which means you don't get any deduction now, but it also means that when you pull that money out later, it would not be taxable, that principle we talked about earlier. So you may still benefit from the non-taxable, a non-deductible IRA, because the income on that IRA during the time it's in there is still not subject to tax until you withdraw it. All right. So Roth IRAs work a little bit differently than regular IRAs. They're not deductible now, but the withdrawals are not taxable. That's that principle. So a Roth IRA is not, if somebody makes a contribution to a Roth IRA, now it is not going to be deductible at all on their current tax return. And in fact, they may not even be allowed to do so at all. Contribution limits are the same as traditional IRS, at 6,000 or 7,000, but your phase out, the amount that you can actually make that, starts at 193. Married filing jointly 122. You can see the ranges here, and the phase out range backwards from what we're used to. Married filing jointly is a smaller range than everybody else. Okay, so if you're 203, you can't make a Roth IRA, and if you do, you actually have to pay a 6% penalty. So at that point, your only choice is regular IRA, and if you participate at work, you're excluded from that. You could make a non-deductible regular IRA contribution, but that would be your only choice. All right, so there's the trade-off of the two accounts. The other thing about Roth IRAs is for a traditional IRA, there is a required distribution. You have to, at some point, take money out, even if you don't need it. And if you don't, there's a 50% penalty. It's very expensive, so you do it. That does not apply to a Roth IRA. So you can let it grow and carry it forward to your kids, things like that. So that's another kind of important difference between the two. All right, now these are not retirement plans per se. This is CISAs, or Culverdale Education Savings Accounts. Save money for future payments for tuition and other education expenses. So not deductible now, okay? You don't have to pay taxes on any interest you're earning in there, okay? And the distributions are not taxable when they come out, but only if you spend it on higher education expenses. So you can do it, any person can do it for any other person, including themselves. Okay, notice the limit though is pretty low, only 2,000, well below the IRA limits, and it gets phased out, as so many other things do. Okay, at 190 through 220 and 95 through 15, which means you can't even make the contribution. Now notice it's 2,000 per beneficiary. So if you have 4 kids, you could make $2,000 to each child, or if you're grandparents and you have 30 grandchildren, you could put 2,000 in each one. So it's not limited in what you put in, it's limited per beneficiary. And that's all that can go into that beneficiary's account for that year. So if grandma puts money in, parents can't put the same. If grandma puts 1,000 in, parents could only put 1,000 in it as well. Okay, so you have to coordinate between folks as well. So that's pretty limited. So that's become less popular, and the most popular way to save for education is a 529 plan. Again, the earnings grow tax free. Qualified education expenses, when you pull it out, as long as you pull it out, it's still not deductible currently, at least for federal taxes. But an interesting sidelight that just for tax jeopardy someday, it is deductible for state in Pennsylvania, as long as it's a state tuition plan. Most states sponsor these. Okay, and the qualified expenses are a little broader than we're used to. Okay, in other definitions, and you can use it. Okay, for tuition at K through 12 schools. So it's not just college. If you don't use the money, you have a 10% penalty, which is typical for any retirement plan or any other tax-deferred plan where you don't spend the money on the right things, or you take it out early, you have a penalty. Okay, you can roll it over to another family member. So, for instance, if you amass $50,000 for a child and they don't need it all, you can use the part that they don't use for another child, roll it over to another. You can do it. This doesn't affect your ability to use a Coverdale account, and you can use it the same year. You take money out, okay, and use or the tuition fees deduction or education credit. So, for instance, if you had someone with $20,000 of tuition, you pulled $10,000 out of your 529 plan, that would be tax. That would not be income, okay, when it came out, and would be paid for tuition. And then you pay the other $10,000. That could be used for either the education credit or the American Opportunity Credit or any other education benefit. So you can, as long as you have enough of the expenses, you can do both. But you can't use it twice. You can't pull, if it was only $10,000, you pulled $10,000 out of your account, you can't use that same $10,000 to qualify for the American Opportunity Credit. All right. Distributions. All right. So money coming out of any of these accounts are generally taxable if the contributions were deductible. All right. There is a simplified way, partially tax-free, partially taxable. If some of the money went into the account pre-tax and some went after tax, okay, then you have to kind of allocate. So you determine the number of anticipated payments. The single life and dual life tables are in the back of this chapter, okay, and you look at that is how much the total payments are going to be, all right, and then you take the contributions from your previously taxed dollars contribution and divide it by the total amount of payments, okay, or actually divided by the number of payments. So it gives you a number of payments that you would get based on your age in this table, okay? And so that fraction represents a portion of each payment that will be tax-free. So, all right. We talked about the distribution from a regular IRA and a 401k, that sort of thing. You have to start taking distributions, There is a life expectancy table, table 3 in the text, page 1129, that determines how long you're going to live, okay? And it changes. Notice that it changes each year, and so you have to pay attention to that change. So you're basically going to take the value of the account and you're going to divide by what you have left, and that's how much you're going to have to take out of the account each year. This changed in 2020 to 72. It was 70 and a half, and there was a tax law change just at the beginning of this year, which moved that back for subsequent years. But for our purposes, we'll still assume that it's 70 and a half for 2019. Okay. Roth IRAs are generally not taxable. You've got a lot of flexibility with the Roth IRA. Earnings are taxable if withdrawn prior to a 5-year. So if you leave it in there for 5 years, you can pull out even the earnings. Okay. But the earnings are taxable, not the original contribution, and you're treated as taking the contributions back out. So if you put in $10,000, it earned another $5,000. When you start pulling it out, it's assumed to come from the contributions first, the original 10, and not from the earnings. It wouldn't be taxable until you started getting into the amount of the earnings. Okay. And premature distributions, the ones that don't follow the rules, are subject to a 10% penalty. There's a list of exceptions. Usually when there is a financial problem that causes you to have to pull money out, they've added to this list. It used to be a much shorter list, and it keeps adding things that you can take money out of your IRA, 401k, and still not pay the penalty. It's still income. It's still added to your AGI, but it's not. You don't have the additional 10% penalty. If you follow the rules, you can roll it over to another IRA. The easiest way to do that is what's called a trustee to trustee. You just contact your bank. You tell it to put it in a different bank, and that goes straight across, and it's non-taxable. And all the paperwork will say to the IRS it's not taxable. If you pull it out, sit on it, you do have 60 days to put it back in. If you realize, that was a really stupid move, and put it back in. But that's going to require extra paperwork, and it's not, the paperwork's going to look like you pulled it out just plain, and the IRS is probably going to try to charge the 10% penalty unless you can prove otherwise. So you have that 60-day window, but you want to just do this direct transfer, and then it's so much easier. All right, so that's how rollover. Now, if you roll over from a regular IRA to a Roth IRA, the whole balance is taxable, and there needs to be, you have to pay that tax at that point, but then you have the ability to pull the money back out at the end without including it in income. So a lot of rollover issues and things you have to consider and from a regular IRA to a Roth IRA. That's kind of the decision of the day type of thing. So we'll have this finished up with retirement planning, except for the last thing we will talk about in our part 3 is annuities and how they are taxed.